Today we got Tore Alden with Fastmarkets, head of commodities trading with Fastmarkets, and Dennis Leontiev, my former partner at our hedge fund, Melange. Tore, how are you today? And just wanted to check in with you and to see what your thoughts are in the commodities markets.
I'm good, Andy. Nice to see you guys. I don't know if we have to restart. I'm not head of commodities trading. I'm head of research.
Oh, pardon me. Yeah, head of research. No, that's fine. Thanks for the correction. We'll keep rolling.
No, I just don't want them to think that I'm trading commodities at this point. I'm good. It's WASD Day. That's always fun. Although I think the June report always has to feel a little bit like the middle child, because it's for corn and soybeans, there's not really any production update, and everybody's really kind of looking forward to the acreage report and the grain stocks report at the end of the month. And USDA generally doesn't make any huge changes, and today was kind of fit into that mold very well. I think most people are right now focused on the weather and whether the dry spell in the Corn Belt is going to continue. I think that it still is early enough that you can get just, what seems like probably not enough rain, but the plants are so small and the water requirements are so low that it doesn't take a whole lot of rain to support the crop at this point. Of course, you don't want the ground to be dry, so that if it doesn't rain as much in July or when the crops get bigger, there's not enough soil moisture to support them through a little bit of a dry spell. But I think that's really sort of the key driver. The thing that surprised me more today than the WASD report was the announcement of export sale of soybeans today, which is odd because Brazil is like $50 or $70 cheaper, depending on exactly where you're going. And so I don't know, Brazil's on holiday today, so maybe somebody just had to buy beans today and couldn't wait until Monday, and so they bought them from us. But I would think that those would slow down pretty quickly given the price discrepancy between the Gulf and Brazil, or the PNW is even worse. And outside of that, I think, just kind of seeing where the weather goes and how the crop develops. I think kind of longer term, we're going to head from several years where South American production hasn't been yields haven't been at trend line. And so I think that on some level of the market this summer is going to start to need to price in the reality of 200 million tons of soybeans and nearly that, I suppose, of corn coming out of South America each year. And I think that means ultimately, probably, at least for soybeans, the US becomes much more of a domestic market than it's been. China will always need to buy some US soybeans, and they'll always want to buy some US soybeans. They like to keep their options open in terms of suppliers, but I think that you probably will see kind of a slow drift lower as Brazilian production continues to rise. And based on a couple of years ago, I talked to some seed companies, and they said that the new genetics that are coming out in the seeds are just unbelievable. And we hadn't really had an opportunity to kind of see that yet, I think, until this year in Brazil. And I think the size of that crop down there is just amazing when you think about essentially Rio Grande do Sul was maybe half of what it should have been, or less. So you could have easily added another 10 million tons onto Brazilian production. And that's what you're going to get going forward every year. So it's going to be tough to compete in the export market, except right after harvest, basically.
Got it.
That's kind of it generally.
Got it. Let me ask you then, and if you could work out a little bit more of a, you mentioned the weather, and you mentioned more or less bean quality, or how they're making beans genetically and that sort of thing. But I guess work out global macro a little bit more. How much does that have an impact? I mean, we got some tensions, as sure you're aware, around the world. How is that does that have much of an impact, or how does that factor into the prices this year?
Yeah, I mean, I think that there's probably two major kind of macro things, at least that I'm thinking about right now. And one is sort of the recovery of the Chinese economy after COVID, and then, as you mentioned, the ongoing situation in the Black Sea. This week's accident at the dam, whatever happened at the dam there, it was a stark reminder of what can happen there. However, I think really, I don't know that either side really wants to put themselves in a position where they're not going to be able to export anymore. And so I don't, bad things can obviously happen, and who knows really what would happen there. So I think you probably get a little bit of risk premium in wheat and some of the veg oils. But ultimately, I'm not sure that I think that they actually go far enough so that they just shut off exports from the Black Sea. On China, I think that, basically they had the zero COVID policy, and they kind of did what we did over maybe a longer period where they kept everybody locked up. And then once they kind of went away from that, then everybody went out and everybody got COVID. And so I would think that they are 9 months or a year kind of behind where we were when we kind of came out of COVID. And so I think that they probably will recover, but a lot of that probably depends on what happens in the US and whether we really are starting into a soft landing, a hard landing, something worse, or something better. If China's customers don't have any money, then they won't necessarily recover as quickly as they have in the past. And I think there's probably a good chance that happens anyway, just because they're much more developed now than they had been in the 90s or 2000s or even 2010s. The one thing about China that has surprised me quite a bit, honestly, is that when China got ASF, the government sort of rightly took it as an opportunity to transition their hog industry from sort of, at least a substantial portion was people with 3 pigs in the backyard that they kind of fed table scraps and whatever else was around, and transition it to a modern hog industry with the big hog hotels. And I assumed that would mean that their soybean meal demand would just kind of take off. And it hasn't been as strong as I expected. Now, part of that is they're having some more problems with ASF, not as bad as they did before, obviously. But I don't know that explains all of the decline in meal demand. Maybe some of it is COVID related or weak economy related, but even that doesn't quite get all the way there. And so one of the things that I'm really sort of looking forward to is when they do get back going at whatever kind of their equilibrium is, or whatever rate that they're going to grow kind of going forward, to see what that soybean meal consumption looks like, because so far it just has not been close to what I thought it would be kind of going into that transition. And that is going to make a huge difference in beans. I mean, if China doesn't come back, then for beans, they will not import 100 million tons, which I think is where I started this year out. I don't think they'll hit that for a couple of years, probably. On the corn side, I think that they are, their feed demand is surprisingly not down quite that much if you look at all the different components of feed. And that means that they're going to continue to import probably 25 million tons of corn a year. But again, with more competition out of South America going forward, I've got our corn export forecast for 23-24 back up above 2 billion bushels, but I kind of wonder if that's not going to be something else that I kind of whittle away at as we get closer to the marketing year and then kind of through the marketing year. And on wheat, I mean, I think wheat is one of the things that did surprise me out of the USDA report today was for wheat, you had a kind of a bearish report. I mean, in the US, not so much, and there certainly are a lot of concerns about abandonment this year and what the winter wheat crop looks like. But if you look at the world stocks number for wheat, it was really, really bearish, and wheat didn't really react that way, which doesn't surprise me. I've never been good at wheat, and so I kind of think that it was probably caught up a little bit by soybeans move today, and then corn kind of tried to hold in there, and then again some concerns about, well, really how much are they going to harvest in Kansas and Oklahoma, and then the dryness concerns for spring wheat that we have for corn and soybeans. But I think sorry, I kind of deviated there from your original question.
No,
I
it's
think
fine.
from a real macro perspective, the key is, does the economy really slow down here in the next 9 months or year? And beyond that, I think it just comes down to the South American supply. And South American supply could take us back to, it could look very much like sort of that 2014-15 period where we had really, really tight stocks. And then as we came out of that, we started to build stocks. Bean prices fell down to like 8 something, and corn fell down to 3 something. And so I think we could pretty easily get back there in 23-24 if the US crop is trendline, or US crops are trendline. If not, probably by the time we get to next spring's planting, we'll probably be closer to that range than we will to the prices that we've seen the last couple of years.
Got it. It leads me to another question is, you mentioned like the economics, or I guess the economy, China slowing or opening up, and that sort of thing, but also here domestically. Other than a recession, because it's somewhat, some people say we're going into recession, others say that we're not. How much does monetary policy have an impact on commodities, if at all? And it might not at all, but yeah, what are your thoughts on that?
I think that I've gone back and forth on this a little bit, honestly. It is something that I've thought about, and I've wondered, whether sort of the last big bump up that we've gone through, and really 2022, whether 2022 was kind of weather driven, monetary driven, a perfect combination of the two. I guess what I would say generally is that, to the extent, if you think about sort of money supply over long term. So when I started was 1998 or something, doing this actually professionally.
About the time
Yeah, it was.
we're old.
There was, unfortunately.
Dennis told me the other day we're dinosaurs.
Every day it just gets, it doesn't stop. Like, it just doesn't stop. The days keep coming.
Right.
But back then, like, corn was essentially $2 and beans were $5 and wheat was like $3 or something like that. And if you got a 15-cent day in beans, like, that was a big deal. And so now, if you think about, okay, that's where we were there. Now we are, if we hit $8 in beans, that'll be a really low price. And outside of monetary, the impact of the money supply, there probably isn't a lot to explain that, right? Like, stocks and stocks to use are all still kind of in the same range, or move around in the same range that they did then. And so I think it probably is something that it has a much more modest but definitive impact, but it's over a very, very long term. So I don't know, unless you're buying like ag land or something like that, I don't know that that's sort of a tradable a tradable insight. I think probably the dollar and in the strength of the dollar, which obviously is also related to money supply, probably has a much more significant impact on day-to-day price movement. And so if you can figure out where the dollar is going to be in 3 months, you probably can also kind of figure out, at least within the trend, where commodity prices are going to be and whether they're going to be sort of at the upper end of the range or the lower end of the range. But supply and demand still will always be kind of the main, at least from my perspective, the main driver.
Got it. Dennis, I want to include you. I have a couple more questions, but what did you want to ask, Tore?
I was just wondering at your firm, do you guys primarily, I don't, maybe you don't trade commodities, but guys who do they employ more of a fundamental macroeconomic research? Or I know a lot of CTAs, they do trend following and more quantitative. So is it a combination of both? Or how do you guys approach commodities in general?
So we really do a lot of fundamental. I think that's primarily, it's been my background and sort of the way that I've always thought about commodities. In the past, when I've worked at hedge funds, there have been probably more fundamental traders than technical traders, or I guess what I would really say is probably non-fundamental traders. So at one of the hedge funds I worked for, the one of the partners who was the head of ag, he essentially just traded volatility. And so fundamentals play a role in that. Obviously, if you have tight stocks, volatility is going to be higher. But if you want to be a hedge fund manager and you want to generate returns year after year after year, then you have to find something beyond whatever that is, and a way to trade volatility kind of week to week, month to month, that kind of thing. And for ags, it turns out that it's relatively seasonal, and obviously, so like, you know, the run up to US planting, volatility tends to increase, and then it tends to peak in June and kind of tail off from there. Other than that, the one of the other hedge funds that I worked at they were interesting. They were really short-term spread traders, and they traded electricity in the European markets. And so they spent all of their money on order entry and felt like they had the fastest order entry. And so they were essentially trading the same commodity on a couple of exchanges. And when a spread would get out of whack on those exchanges, they would just hit that. And that was enough to actually generate a fairly substantial profit for that firm. And they hired me to do ags, but they wanted, like I said, well, what's your time frame? And they said, well, you know, you see how we trade, and so we could maybe think about like a week, but that'd be pretty long for us. And so I tried to do that, and that was not, obviously did not work out that well. But I think for most people, probably in commodities, I think probably view the market as long-term driven by fundamentals, or over the next 2 to 3 months, or whatever your trading horizon is, probably more driven by fundamentals. If you're a short-term trader, you're probably more driven by technicals. But even if you are a fundamental trader, and when I traded, this is how I approached it, was I would look at the fundamentals to try and understand those, to get sort of a view on where I thought the market was going to be 3 months, 6 months down the road. And then I would use technicals to try and enter into or exit out of trades. And I think that for most fundamental traders is still probably the way that they do it.
Yeah.
My question to you, Tore, is, speaking of the, I guess we could call it technicals, is when you're looking to enter a trade, what exactly are you looking for you to start averaging in, if you would?
So I keep it relatively simple, and I use, although my charts look horribly complicated because I use I don't even know how to say it, the Icho, the Japanese cloud thing. and that has like tons and tons of lines, right? So I kind of use that just as a backdrop. It's relatively good at sort of providing an idea of when the market has overextended to the downside or the upside. Beyond that, what I use more than anything else is sort of just very simple RSI, very simple stochastics. And what I look for is on probably an hourly chart, is the market oversold or overbought, depending on which way I would want to get into the market. And the other thing that I do as much as anything, and certainly the thing that I probably have more confidence in than a lot of other things, although it can bite you, are Bollinger Bands. And so again, if you look at an hourly chart and prices are at the lower end of a Bollinger Band or the upper end, again, depending on which way you want to go, just statistically, it makes sense, right? So it's one standard deviation of price movement depending on the recent volatility. And so if the prices trade outside of that range, you essentially have a 2 and 3 shot that they're going to go back into that range. And so those tend to be good setups. The only time that they don't is if the market is in a, it tends to be, well, I guess it tends to work both ways actually, but if it's going to trend hard or it's breaking out of its recent trend or it's built a base and it's starting to break out, then it'll continue to just kind of hit the upper end of that Bollinger Band over and over and over again. And so you want to be aware of the technical tools that you use, their strengths, their weaknesses, when you really can rely on them, and when it's probably best not to pay super close attention to them.
Got it. Dennis, do you have anything else?
No, I think it's very informative.
Yeah. All right, Tore, if somebody wants to get in touch with you, how would they go about finding you and doing that?
Sure. You can reach me on LinkedIn, of course, or you can also reach me. My email address is just my name, Tore, and then there's a dot between the E and the A. So Tore.Alden@fastmarkets.com. And yeah, I would love to hear from anybody. If anybody has any questions, I'm always happy to talk about the markets, because, you know, you can't talk about this stuff with your family. You get that sort of that look.
Yeah.
And so I'm always happy to talk to almost anybody that'll listen.
We understand. We relate.
Yes.
All right. Well, thank you so much, Tore. I wish you a great weekend, and thank you for your time.
Thanks. You guys too. Talk to you there. Bye-bye.
Thank you.